Okay, welcome back for the third and final segment of intangible assets. Here we go for the recording of the intangible assets. Okay, on 1/1/13, we've got a transaction to account for. We have purchased a patent, so we are going to reduce cash by $120,000. Let me push the patent over here a little bit. And we are going to recognize an increase in this asset patent. Okay, simple enough. We've got an asset here that we've purchased on January 1, 2013. When we come down to the end of the year, we've got an expense we have to recognize, which we just calculated as $12,000 for the year. So that is going to be a expense that we're going to recognize. There it is right there. Amortization expense. Be listed on an income statement with our many other expenses, wage expense, rent expense, or depreciation expense, those types of things. And instead of having to use a contra account, as I mentioned, we can directly reduce the asset, which makes it oh so much easier. I think you'll agree. So I can get this in the right place here. You'll see that when we're done, we have a reduction to the asset patent, and we have the recognition of amortization expense. Pretty simple. No need to worry about salvage value. No reason to worry about using a contra account. No reason to worry about net book value or any of that type of thing. It's just a reduction to the asset account and the recognition of an expense. Now let's say that we had that same example, except that we got the patent on July 1, 2013. So, on 7/1/13, we're going to have a reduction in cash and the recognition of this asset patent. By the way, it could be a copyright, could be a franchise, could be any number of things. And on 12/31/13, when we recognize an expense, and I'm going to go back up here and highlight this, it was $12,000 for a year of amortization expense, but in this case we're talking about 6 months, from July 1 to December 31st. So we're going to have a partial year worth of depreciation, or $6,000 worth. Is the calculation right up here. So, how do we record that? It's going to be a direct reduction to the asset. And the recognition of an expense, $6,000 of amortization expense. Just to complete that thought, if we roll forward to the next year, 12/31/14, we're going to recognize 12 months worth of amortization. That'll be $12,000 direct reduction to the asset, and $12,000 as amortization expense for the year 2014. And we're going to recognize an expense over the shorter of the legal life or the estimated useful life. In this case, we're choosing the legal life of the asset. So again, very similar to depreciation expense, but simpler in that we don't have to worry about salvage value and we don't have to worry about using a contra account. All right, two other types, special types of intangibles that I just want to mention is a goodwill. Goodwill happens when a corporation purchases another corporation and pays more than the assets, I'll say more than the net assets for the purchase price the additional amount paid equals goodwill. So that would show up on the corporation that bought the other company. That would show up under their intangible assets as goodwill. That's where that comes from. So goodwill, you can think about it, is externally generated. Means outside the company because we as the corporation purchased another company and paid something more than the asset value of that company. We bought some goodwill, basically, is what that amounts to. And the other type of sort of intangible expense is research and development. You can think about that as companies that spend money to, research and develop other companies, other products rather, or different ways to do things. That is recognized immediately as an expense, not an intangible asset. So I just want to mention that because the chapter talks about research and development. Used to be that was an asset, but is now recognized as an expense, just like all our other types of expenses that show up on an income statement. Okay, that completes our lecture on intangible assets. So I call your attention to this. This is for take-home exam number 3. Total exam points are going to equal 20 points. So here's a great opportunity for you to get a head start on exam number 3 and crank up 20 points that go along with it. So I'll sort of read this with you, but you can see it yourself, I think. I'm asking for the balance sheet equation, of course also known as the accounting equation, what we've been working with, for the following. On September 1, 2013, Strand Corporation received a copyright, cost $200,000. The copyright had a 7-year legal life and an estimated useful life of 5 years. I'm asking you to calculate and record the amortization expense for 2013 and 2014. By the way, up here on number 1, I want you to record the transaction, having purchased the copyright. So number 2, calculate and record amortization expense for 2 years, 2013, 2014. Third part, explain the difference between tangible and intangible assets. And number 4, provide at least 3 examples of tangible and intangible assets. So, this part will be turned in with your take-home exam. That exam, per your syllabus, will be given on Thursday before Thanksgiving week. And check your syllabus as to when it's due, but it's due the first class after Thanksgiving, which I believe will be Tuesday, December 2nd. Okay, so I hope you've enjoyed not having to find parking spots and sit in the classroom, and picked up some information on intangible assets along the way. And this will also give you an opportunity to get a head start, a good 20 points, 20% of exam number 3, by taking care of this intangible asset problem. All right, very good. See you in class.